Have you ever wondered how the mega rich invest their own personal money? Well, thanks to Goldman Sachs, we've got a report that they produced in 2023, the most recent version, where they surveyed over 166 family offices globally. And in today's video, I'm going to walk through the contents of that report to give you an idea of how the mega rich invest their own money and what you can learn from that. So before we get into it, let's define what a family office actually is. A family office is really a private firm that handles the investment management and all the investment tax needs of the super wealthy. By super wealthy, we generally mean families with $100 million or more. For the purposes of the Goldman Sachs study that they put out in 2023, around 72% of the respondents reported a net worth of at least $1 billion. So we're talking the top 1% here. When it comes to the investment strategy that family offices employ, one thing to really keep in mind is what they're really thinking about here not only is increasing their wealth, but it's preserving it and preserving it for generations. They want to hand this wealth down to their kids, grandkids, and so on and so forth. So their time horizon is very long. They also may have much more complex needs or investment strategies that they need to employ in order to achieve those goals. All right, so based on that, now we know what family offices are. Let's get into the report to get right into the portfolios of some of the highest net worth people from around the world. Okay, so on my screen right here, we have the report that Goldman Sachs put out in 2023, their Investment Insights report on family offices. I've jumped right ahead and gone right into the actual portfolio, so we get right into the meat of this right away. So as you can see, what they did was they published their first one in 2021, and then they followed it up 2 years later in 2023 with an update. So what we'll do is we'll focus on the 2023, and perhaps in 2024, 2025, they'll come out with another one. So on the right-hand side, we have the portfolio average asset allocation of global respondents in 2023, as we can see here, percent of portfolio. So as you can see here, 28% of their portfolio is invested in public market equities. So what are public market equities? Well, they're really stocks, something that I talk about an awful lot on this channel. That to me is actually surprisingly very low. I would have expected they have a much higher allocation to public market stocks. It's not uncommon to see portfolios around 70, 80, even 90% invested in stocks themselves. So this was actually quite surprising to me that they go so low in the stock market. Next up, we see they have around 12% in cash or cash equivalents. And really, that's just cash sat on an account. I was super surprised at this. I would have thought they would have been much lower, maybe in at around 5%, but they have, at the point of this study anyways, around 12% of their assets in cash only. This comes off to me as being very conservative. Next up in green here, we can see they have 10% allocated to fixed income. What is fixed income? It's really just another word for bonds. A bond is really like a loan. So when you buy a bond, you're actually lending your money to the other party who will pay you interest in return. If we break it down a little bit further into their fixed income portion of the portfolio, we can see they have 4% in treasuries, 4% in investment grade bonds, and 2% in high yields. Okay, so what is that? Well, 4% in treasuries. Treasuries are US government bonds. If you buy a US treasury, you're lending money to the US government, and in return, they will pay you interest back, known as a coupon. So that is a very conservative investment, very low chance of the US government going bankrupt, although there's a lot of chat that could happen if the deficit continues, but 4% in treasuries is conservative. Then they have 4% in investment grade. Okay, so what does that mean? Investment grade is basically highly rated corporate debt. So an investment grade debt would be in companies that, have very strong balance sheets, very low debt, and very low risk of maybe going into default. Then they have 2% in high yield, and high yield is kind of the opposite. When you invest in a high yield debt, you're investing in a company that has a higher chance of going bankrupt. Okay, in return for that, you'll get a higher interest rate in return. Okay, now we move into the part of the portfolio that is really interesting to me and something I wasn't expecting to see as well. We saw earlier where they have a lot less invested into public equity. Here we can see they have 26% invested into private equity. What is private equity? Well, private equity are firms that gather up funds from pools of investors. They put all of that money together and they actually go out and buy businesses. And they tend to do this with kind of a strategy in place to increase the revenue, cut the costs, and potentially sell that business in 5, 10, or even 20 years down the road. And that's what we see in the 11% of buyout. So private equity firms that would go in and buy out a company and try and make it more efficient, make it more money, and then turn around and sell it down the road. They can do this with high growth companies as well. Maybe younger companies that have been up and running for a few years trying to get to that next level. Private equity will come and invest money, get an ownership in that, and try and make it as efficient and profitable as possible. There's also 7% in venture capital. What's venture capital? This is really where you get into startups. Think about it. If someone has a new business idea, a new app, new technology, whatever, and they want to get money to get this up and running, that is known as venture capital. They'll go to a venture capital firm, a private equity firm, and say, I need X amount, 10 million, 100 million, whatever, to put this business plan into practice, and in return we'll give you a percentage ownership of the business. That's venture capital. So this is much higher risk than, say, investing in public stocks like, Apple, Microsoft, and all the big names, let's say. This is venture capital where you can see very high returns, but very high risk as well. As you can imagine, a lot of companies like that never actually make it. So private equity makes up a big part of the mega riches portfolios. Okay, next up after private equity, we see private real estate and infrastructure. So this is where the mega rich will invest their money into private real estate transactions. So this doesn't have to mean residential. This actually typically means things commercial. And by that we mean things like shopping centers, office buildings, even data centers, warehouses, anything like that. They will invest their money into private real estate and try and get a return or monthly income from the rent that's generated from there. They can also invest in funds that invest in infrastructure. Governments like to invest in infrastructure by building bridges, roads, all sorts of things like this, waste treatment, the whole thing. And there are ways for people to invest in these infrastructure projects. And of course, the wealthy are doing this through private real estate, private infrastructure, and funds that they can get invested in. They get access to this mainly through their banking needs, like Goldman Sachs, for example, who can set them up with these deals. The main thing about these deals, the private equity, the private real estate, and infrastructure, these tend to be long-term plays, particularly when it comes to the real estate and the infrastructure. This isn't something that they're looking to buy or sell in a year or two. Next up on the list are hedge funds. I've done a video before on funds. I'll put a link into the description here that you can watch to get an idea on that. Hedge funds are actually pooled investors' money, like mutual funds or exchange traded funds. But rather than just buy stocks, for example, or bonds, hedge funds have the ability to also go short. So they can actually profit from a falling market. They tend to be riskier because they can borrow money as well at times if they want to go short by borrowing stocks or borrowing money to go long. That's known as long short funds, and they can invest in all sorts of different asset classes. Their fees are extremely high and the returns have not been great. Yes, some hedge fund managers have fantastic trades and that gets publicized a lot in the media. But for the most part, with the fees being 2% of the assets invested and 10 to 20% of the profits, it's very difficult to make money here. I think a lot of the reason why the mega rich are investing in hedge funds, although it's only 6% of their portfolios, probably due to the fees, but this could be as a way to kind of offset a market crash or a market downturn, because they would like to be invested in an area or in a fund where the person has the ability to profit off a falling market. So to me, that's part of the reason they're investing in hedge funds. Next up, only 3% in private credit. That's really just private lending of one sort or another that they'll do in return for a higher interest rate. 1% in commodities, which really surprised me. I wouldn't be surprised when the next report comes out if that percentage is a lot higher, particularly with the moves in precious metals like gold and silver that we've seen recently. That one in particular was a real surprise to me. I thought they would have more in commodities, and with inflation having been high, commodities can sometimes be a hedge against that. And other is 4%, and that could be things like cryptocurrency, listed real estate, annuities, and operating businesses as well. So there we have it. On the right hand side, the portfolios of the absolute super rich top 1% and how they do this. If you're enjoying this video, why not take a quick second and just click on that subscribe button? It would really help me. I'd really appreciate that. Helps me to grow up my channel, hand off the knowledge I've gained over 20 years working in the financial market. So click on subscribe, get more great videos like this. I would really appreciate that. Thank you very much, and let's get back to the video. Okay, so what are my thoughts on this and what can you take away from this more importantly? In all honesty, in my opinion, I don't think you're missing much by not being invested like a super rich person. There's an awful lot there in private equity, and private equity is not that easy for you or I to get into, but there are ways to do it, particularly by using ETFs that buy into the company stocks of private equity companies. Some of the hugest private equity companies like Blackstone, KKR, the Carlyle Group, whatever, you can buy ETFs that will buy the shares of those companies. So if you want to get exposure to private equity like the mega rich do, you could look at buying these ETFs. Another takeaway from this, I think, is the amount that they have in cash and in fixed income. I think that's too high. If you're a young viewer, say in your 20s or your 30s, even your early 40s, I don't think you need a cash component, anything like that. In fact, to me, I think you only need maximum 10% in cash. One of the things, if I could do over again, I would have had less of my portfolio in cash and fixed income. 20-30% is what a lot of the guidebooks recommend. I think that that's too high, especially if you're younger. So if I were you, I would reduce the cash or the fixed income bond part of my portfolio and keep that to 10% maximum. If you're feeling like the markets are too high and you're a little bit scared, you could reduce it, your equity exposure, and maybe go to 12 or 15%. But I think that's too high overall. Up to 10 is probably the best for you. Remember, you've got a long-term investment strategy in place. You're investing for the long term. Don't worry about it too much. When it comes to the real estate investments, here's what you can think about. Number one, are you invested in real estate through your primary residence? Let's be honest, a lot of people are, and that's the primary source of wealth and the biggest asset that they have. So if that's the case for you, then you don't need to worry about it. In my opinion, you've already got your exposure to the real estate market. You're not going to go out and buy a shopping center or, an office building or something like that. So you can forget about that. Use your residential property as your main investment in your real estate. That being said, if you did want to add some to your portfolio, there's another way you can do this: real estate investment trusts. A real estate investment trust is really a type of fund, again, pooled money from investors, and the trust will go and it will buy commercial real estate, things like shopping centers, and it will take the return from the tenancy agreements, from the rent that it includes. They're set up so that they have to distribute 90% of the rental income that they get back to their investors. So the main reason you would buy a real estate investment trust is you like the yield that it pays out through a dividend. They're listed on the stock exchanges, so you can have a look and either buy real estate investment trusts directly, also known as REITs, or ETFs that invest in real estate investment trusts, so you get the diversification. But that's something you could look at if you wanted to replicate the portfolios of the super rich. So that is how the mega rich invest their money. There's an awful lot that's going into alternative investments, private equity, commercial real estate, but don't let that discourage you. Like I say, there's ways to get invested there. If you're watching this video and you're not on a huge income or a huge salary and thinking, how can I get myself more and more money invested in my investment accounts? Then I'll put a video right here, which I did on the Ronald Read story, how somebody on a very low income was able to generate a stock portfolio worth $8 million. It's a real life story, unbelievable, but true. Click on that. I'll see you over there, and all the best in your savings and investment journey.